Let's go now to our friend Bimnet Abibi from Galaxy Trading. As always, Bimnet, great to have you.
Thanks for having me on.
Hey, big day, Fed Day.
Fed Day.
Fed Day. Was it a Super Bowl day?
No. It's like a wild card playoff round at best. At best. I mean, this was like the most lackluster, uninspiring FOMC I've seen in a while. And I think it just goes to show you we're near the end and that there's going to be a lot less volatility that's going to be a function of Fed policy. And I think the future drivers of markets or the next sort of big things for markets are going to be less oriented around Fed policy. Mm-hmm. So yeah, I mean, it was an exciting day. Powell, basically said that, they hiked rates right now because the data suggested that they should, and that going forward, they're going to be data dependent, as they always have been.
Same story.
Same story as last time. There's very minimal changes in the statement.
Yeah, it was very minimal.
He did acknowledge, the constructive elements of the last, CPI print, and that, if they were to see follow on, that would be, a welcome sort of sight.
Which we all know, right?
Yes, correct.
So it's like he's just saying he's
just reiterating the same stuff,
yeah.
And then he still, thinks that the balance of risk is skewed towards not doing enough to combat inflation, rather than
going too hard
and hard landing, and because that stuff's reversible.
Well, and we've been talking about this now for months, maybe even a year.
Yeah.
The hard landing, we're just not seeing it yet. Like it
No,
could still come, but it's
definitely not
unemployment's still
happening.
low, the housing market's still high, wages are still going up.
Yeah, I mean, we've forecasted away the recession that we had forecast.
Yeah.
Right, and so there's definitely been stronger elements of growth, but what's important about this stuff is that this growth hasn't come at the expense of high inflation.
Yeah.
Or it's come at the expense of inflation as inflation has been coming down. One interesting statistic that, I just got from Jeffrey Gundlach, famous bond investor at Double Line Capital, is that if you replace the owner's equivalent rent component of headline CPI with more live, accurate housing metrics, you'd be talking about headline inflation, that was at zero or close to it.
Wow.
Right? And so there are certain elements of the inflation story that tell you, the Fed should be done right now. That, monetary policy works on a lag, and it's clearly working. And we're getting even more restrictive now when we're seeing it working. And so it really depends on what your perspective is. But there are just so many strange structural elements to this, like the current macro landscape, that it makes it very difficult to have confidence in your assessment, right? Is housing tight because everybody has a mortgage and supply tight, right? Are rents going to come down? Are there structural things in the supply chain that have fundamentally altered, where inflation can get to and where it can't, et cetera? And so there are all these new, strange post-COVID dynamics that market participants and central bankers have to take into account.
Right.
So it's really tough to say with any confidence, this is what you should do.
Right.
In addition, I think it's worth noting that you've only just had one soft inflation number.
Right.
There are there are elements of weakness, but you still have the tightest labor market in history, right? And prices are still going up. They're going up at a relatively slower rate, but
still higher than you'd like.
Correct.
Yeah.
And then the other thing that's really important to note that I didn't think Powell did a great job of addressing was the easing in monetary conditions. By that, I mean stocks are at the dead highs.
Yeah.
NASDAQ's up 38% on the year.
That's crazy.
Right?
I think you said that to me last week or the week before. At the time, it was up like 40%. I'm like,
yeah, it moved down last week.
It's like what, one of the best stock years ever for the NASDAQ?
Yeah. Absolutely.
Meanwhile, everyone has been out. It's been a wall of worry the entire time.
Wall of worry.
Yeah.
And the pain trade was higher because everybody was worried.
It's crazy.
And now it's like, wait, if stocks rip another 10%, everybody's gonna feel rich again.
Yeah.
And what does that do to inflation?
It should push it up, yeah. People spend more. I mean, yeah.
Spend more, feel richer,
take
wealth
more debt out,
effects.
think that they can. Remember what people were doing at the 21 manias? They were mortgaging their homes, or they were buying like Dogecoin using their stock portfolio as collateral.
I mean,
like
at 2
people were,
3/4 interest rates,
Yeah.
I'd borrow as much money as possible to buy
that's what people were
Dogecoin.
doing. I saw there's this terrible like Reddit subreddit where
Yeah.
like there'll be like people that they ask for like financial advice and like sometimes you see screenshots like they're really bad.
They're really bad.
And the guy's like, I put up my stock portfolio at the highs, like to use it as collateral to borrow money to purchase a home, and now the stocks are all down a lot. Like, can I like get out of it or anything? And
No,
they were like,
those are bad.
Like you're in trouble. But I'm
but
saying
back to your point,
that
though.
attitude could return, and that would cause a lot more inflation too. I mean, that's an extreme example, but like in general.
I mean, meme stocks are the best performing stocks this year. The GS custom basket that I look at, I think, is up 100%.
GS has a meme stock basket.
Oh, absolutely.
Love that.
Absolutely.
Wow. So,
But anyway, I
yeah.
think you bring up an important point, which is, right, monetary policy is meant to address, like, the needs of the everyday person, right? The reason why Powell feels so compelled to hike rates by 550 basis points in such short order is because the average person, like, their ability to consume has been constantly getting eroded. Now, the question is that level of erosion getting to acceptable levels?
Right.
Right? And when you look at headline numbers, they actually look okay, right? But there's just still perpetually the risk of reacceleration.
Yes.
Now, I think it brings us to just another point, which I think is worth noting, is that like households are actually still okay, right? If you look at like credit card delinquency data, it hasn't shot up that much, right? Household savings, they've come down a lot and are expected to decline. Like you still see a lot of spending, right? And so, some of it might be on credit, et cetera, but there's still momentum behind a lot of the consumer and the average, person. And so, like, I'm still in the camp that, like, you haven't really addressed inflation because those people still have jobs and wages are still going up at 4+%, and asset prices are still going up. And while there are signs that, they're weakening things here and there, like,
so now
feels like
they just like lower the magnitude that they're increasing each time. But to your point, you
and
say
the frequency. That's the other
so.
important
What have they
part.
been doing now? Every other one. So they raised. What's the last couple been? So this was 25 bips they raised,
They raised,
and then the last one they didn't.
they didn't raise,
And then they raised 25 before that.
correct.
Did they not raise before that, or have they?
No,
or-
they were raising
That's when
every
they went 50,
meeting before.
25,
Yeah, they
none,
did.
then
So,
25.
yeah, correct.
And
So
now,
they-
what do we think now? They're going to raise through the rest of the year? I mean, essentially, most likely.
So I think the most likely scenario is another hike in November, and there's about, let's say, 10 basis points priced in.
And right, they take a break here, right? They don't do one in August, or they don't
No
do one
one
in
in
September.
August.
So none in
So-
August,
September,
October, November, or
and then November.
September,
Okay.
November.
Yeah,
So you think a pause and then another one in November.
correct.
Got it. So another 25 bips on top through the end of the year, basically.
I think the
Yeah.
market thinks there's another 10 basis points left in the
I
year.
see. So they think
less
like,
than half.
they think less than a 25 bips likelihood, quote
So
unquote.
they're
but you think the full
assuming
25
a
once more.
40% probability
Yeah.
of a hike.
Yeah.
But
you think
then
it's-
what's
you think
really
it's higher,
interesting, is also just the pricing around cuts, right? And so basically,
I saw this on the panel, right? Like the market is pricing cuts like next year, starting next year.
absolutely.
And it's like, we're going to see that. We're not going to see cuts unless there's like massive economic issue, right? Like if
I
the
would-
recession appears, there's no
Correct.
reason to cut.
Right, that's what I think.
Yeah, that's
right?
my
but there
sense.
has to be
yeah.
a structural like premium or structural discount, however you want to
Yeah.
think about it, because the risk is that when they do cut, they cut like 100. You don't
Yeah.
know like the magnitude of the cut, right? Because it like if we are in a recession, it's a hard landing, and there's some shit happening. Like, dude, they could go 200 basis points in a day.
Well,
That
and
takes you back to like
right.
neutral, and
that's
so
why
that's
they brought it all
why
the way up here, so they have all that flexibility now. Yeah,
correct. And so it makes it really tricky.
I see.
To think about. Yeah, and so like you could look at the curve and be like, wait, terminal rates around 350, whatever that band is. Might be too high because if we are going to hit that hard landing and all that,
Right.
like we're going to be cutting rates. Oh, the corn is going higher.
Let's go
look at that.
29.4.
Yeah, 450.
But let's talk about the corn real quick before
Oh,
we
yeah,
break.
yeah,
I mean,
sorry.
because we had a pretty big. I mean,
It's time for the corn to go now. It's ready.
yeah, and we pulled to the top of the range, like or a yearly high briefly after BlackRock's announcement about the ETF, like over the last month, and then we were really just in that tight 30 to 31 range for like weeks. Then we had a little bit of a dump over the last weekend, and got down to what 29.2 ish, 29,
29 the figure.
or even 28 something actually briefly. I
Yeah,
think, right?
basically 29,000 even.
So, but still, we're super low vol. I mean, it's been in this thing for a while. Like, what do we think? What brings us out of this?
Fundamentally, if the market is perceiving the Fed as ending their hiking cycle, or this is kind of it, and EU just had some really weak data. Looks like BOJ is not going to go on yield curve control this meeting. PBOC is easing, etc. And I'm looking at price action in things like silver and gold, and those things are trading really well. And just broader risk assets, stocks being close to the dead highs of the year. If you think about crypto as a function of risk assets and debasement hedges, both of those components would suggest that Bitcoin should be doing well here. And then, the other thing to think about are just more technical things, like what is positioning and funding and derivatives positioning look like in Bitcoin. And I think positioning is a lot cleaner than where it was a couple of weeks ago in terms of levered longs at the highs. I do think that there's been a healthy sort of washout of sort of weaker hands, let's put it that way. And that the path is set for a move higher. Make no mistake, I think, if you do believe that an ETF is coming, this asset is not priced for the kind of liquidity that is coming in.
No.
It is dramatically mispriced. And if you're telling me that the macro currents are going to be supportive of it, in addition to the fact that you're going to get a large ETF
and don't forget, you have the halving is going to happen in about 9 months from now.
Correct. And so
10 months.
I think dips are there to be bought.
Yeah.
And upsides there to be owned.
Interesting.
It's that easy.
Love it. Hey, this was a great one.
Absolutely.
I love that it does feel like easier to do Super Bowl Fed Day now. It's not that everything's
It's not just pain.
Yeah, I know, right? We know where we're at. Well, that's good.
More hikes.
Bim Netabibi, our friend from Galaxy Trading, as always, my friend. Thank you so much.
Pleasure.